showcase. We're going to kick off today with an update from Neil Schloss, the head of retail, to be followed by our office, industrial, and then ending with the V&A. This section will follow very similar formats with a brief presentation and update, and then an interactive Q&A session thereafter. Just some housekeeping before we begin. Please remain on mute and ensure your video is off. With that, over to you, Neil.
Thanks, Nazim, and good morning to everyone. Let's get straight into it. There we go. Okay, so what we'll do is we'll take you through just a bit of the portfolio. Hopefully, then go into some of the trends affecting the sector and our portfolio, and then go into some of the performance around the metrics of foot count and turnover and densities, and then obviously we'll have some questions and hopefully answers at the end. Just to set the background, and this is a slide that's pretty much taken from our June 2021 results. So at June 2021, we had 46 properties. That is now reduced to 44. We've had 2 properties that have transferred during the month of September, and we'll talk to that, but that is Helderberg in Somerset West and Emerald Alberton in the south of Johannesburg in Alberton. We have about 1.35 million square meters of GLA. Vacancy at June 2021 was just over 84,000 square meters. That represented 6.2% as a vacancy. That has declined since June, so it's improved. When I say it declines, the vacancies are lower. Our valuations came in at 24.9 billion rand, and that translates to a value of 18,250 odd rand per square meter. If you look at our geographical split by value, we are predominantly in Gauteng, Western Cape, Eastern Cape, and KZN. That is very much in line with our strategy. We would obviously like to be larger in Western Cape, and we're working towards that part of the strategy. And if you look at Eastern Cape, I suppose one could argue that we are relatively heavyweight in the Eastern Cape, but that includes properties in Port Elizabeth and East London, where we've got Beacon Bay, which is a good property for us in East London. And in Port Elizabeth, we have 2 very good properties, being Walmer Park and Green Acres, both very strong properties. If you look at our segment split by value, we are predominantly in the community and regional shopping centre categories. That is aligned to our strategy. If you take the 2 together, we're probably about 95% in community and regional shopping centres, 96%. Just some key performance indicators over the last 3 years. Clearly, you can see that there has been a deterioration in a lot of those metrics. If you look at just vacancies in 2019, June 2019, we were at 3.9%. We ended June 21, 6.2%. Obviously, a deterioration, very much in line with the economy, very much in line with what has happened with the COVID and the pandemic and how it has impacted specifically the retail sector. It's very well publicised that while our renewal success rate has been relatively high, it is coming at the cost of renewal growth, and we ended June 2021 at -15.6%. That's every renewal that we're doing. We are renewing at on a weighted average basis at 15.6% below the expiry rental. It's not unique to us. I think it's very much a common theme in most of retail at the moment. So it has been a tough couple of years, but we are seeing some improvement from July 2021. Like I said, our vacancies have shown some improvement, while our renewal growth is still negative. We'll have to see that through the course of the year. I think that it will, the decline will definitely be slowed. On our valuations, and again, this is taken from our results at June 2021. I think it's, we've had a couple of years of declining valuation growth. Once again, we had a decline in our valuations of June 2021. It was we declined at about 7.5% across our entire portfolio, translated to around about 2 billion rand. I think the two that stand out here are retail warehouse and vacant land. And that's really just, it's led by one building in retail warehouses, which is Emerald Alberton, which has been sold. And the vacant land is two pieces of vacant land. So it doesn't really tell the entire story of our portfolio. We are seeing regional shopping centres, or we have seen regional shopping centres decline in value by 8.7% as at June 2021. And like I said, the majority of our portfolio is made up of regional shopping centres and community shopping centres, which declined by 2.9%. I think that those regional shopping centre decline was led by a handful of properties. The likes of the Lucia Mall took a significant write down in value, as did Paarl, Brooklyn, N1 City, Bayside, and Waterfall Mall, and those are really the centres that are leading those that decline in value. But as we'll talk about a little bit later, we believe that valuation cycle, the downward trend in valuations, has peaked. It's definitely slowing in our portfolio, and we expect to see it reverse hopefully in the near future. Just some commentary on the valuations, and you can see pretty much a decline or deterioration in most of the assumptions by the valuers. We should see an improvement going forward. I think that just as as an aside, our valuation started, or our process started around about February of 2021, and I think sentiment has probably changed already quite a bit since then to now. But if you have a look at that, our weighted average cap rate increased to 8.17%. Our exit cap rate, which is material to valuations, moved out to 8.48%. Market growth rate declined from just under 4.5% to 4.12%. There was a decrease in assumed market-related rental levels. Vacancies increased in our portfolio over the period to 6.2%. As I've said, those have decreased since then, or improved since then. And then there was an assumption, or there were assumed longer vacancy gaps on vacancies and more conservative market lease assumptions. So all in all, there was a much more conservative approach by our valuers, and that has translated into valuations declining by around 2 billion rand. Okay, just some retail trends that I suppose the market's seeing, and that we are definitely seeing within our portfolio. Foot count levels are still below pre-COVID levels. They are, however, improving and recovering. Turnovers have been recovering faster than foot count, but in many instances, they are still below pre-COVID levels. But again, we are seeing an improved rate of recovery, and definitely from from post the unrest, we're seeing a nice uninterrupted trend of recovery. Supermarkets and pharmaceuticals leading the way. Essentially, those are the essential retailers. They've been strong throughout the call it the 18 months of COVID. We're seeing sit-down restaurants continue to struggle. They are improving, but they're still well off their pre-COVID levels. Personal care is still problematic. Independent fashion is lagging other fashion, and clearly entertainment has had a very, very rough time. There's certain strong performers from last year, such as home electronics and home decor. We're seeing their growth tapering, but I think that's really because of their performance is already in the base. Performance of individual retailers and categories is varied. There are winners and losers, and what I mean by that is not everybody in every category is performing the same. For instance, in your supermarkets, you've got certain operators that are outperforming others. To give you an example, in apparel, we're seeing that value apparel is still leading the way, leading the recovery. And also you'll find that shoes, for instance, are softer. The performance of the shoe category is softer. So it's not to say that you really have to dig into the detail and see exactly what's happening in each of those categories and look at a retailer by retailer performance to understand a lot of those nuances. It's not unique to us that smaller format centres are performing stronger than larger. Community centres in our portfolio have outperformed our regional centres, but the recovery of larger format shopping centres is improving and accelerating. Centres in office nodes recovering slower, understandably, as people are slow in getting back to work. So we're seeing those centres. They may even rely on transport, transport hubs, but definitely those centres that typically relied on Monday to Friday trade from office workers have not seen that trade recover, as people haven't been there in the numbers that they were pre-COVID. Tenant retention remains a key focus, has been for a long time now, will be for some time to come. But as I said a little earlier in the presentation, this does come at a cost, and that cost is lower rentals on expiry of leases. Excuse me. On a positive side, we've seen letting activity has increased, albeit still with reversions at least expiry. And this increased leasing activity is driven by recent M&A activity of retailers. The likes of Mr. Price with their Power Fashion and Yappy Chef, TFG with Jet and Jet Home, where they're rolling out very different concepts. There's store optimization, which is taking place in our portfolio. That is a lot of right sizing. That's not necessarily handing space back. In fact, what we find is the net of that is that we're letting more space through those processes, but definitely where we've got retailers with multiple brands in our shopping centre, we are working with them to get the right size of each brand in that shopping centre in order for it to or for their brands to take advantage and to optimize their offering for those particular centres. And then we've also seen the introduction of new and non-represented brands in our shopping centres. So it's encouraging to see that some of our national retailers are releasing and introducing new brands into our retail market, and specifically our shopping centres, which is very positive for retail in South Africa. We still see some store rationalisation taking place, and within our portfolio, there's obviously been some movement with game. We've had two game stores close recently. That was Bayside in Cape Town, and that was for 4,524 square meters, and that space is forming part of a proposed redevelopment. City View, which was about 6,700 square meters, the game vacated there. We have replaced game there. In fact, all of that space has been relet. And then in FY22, we have one more game which is closing. That will close has closed at the end of October. And that is also forming part of a redevelopment where we are looking to place another mass mart brand in that space, and that's quite well advanced. From the Woolworths point of view, we have two Woolworths that will be closing in the current financial year. One of them is in Cape Town. That is about 4,700 square meters. Again, that will form part of a redevelopment of that particular property. And then we have a second one, which is closing at the very end of FY22. That's about 3,300 square meters. So we, what you hear and what you're definitely hearing in the media, what you're hearing from the retailers themselves, we are seeing some of that within our portfolio.
The sound on my side is off. I'm not sure if other people are having similar issues.
On my side.
We can hear.
I can hear. All good.
Okay. All right.
I'm back. All right. Sorry,
Okay.
apologies for that.
All right. If I can just continue with the retail trends, unrest did impact us in July. We had 2 centres that were impacted. Watercrest was the first one, and City View was the second one. I think just in general, it was very impressive and very encouraging to see how quickly the retailers reacted, responded, and how quickly they got their stores up and trading again. I think at the time it was very hard to see the light at the end of the tunnel when you looked at what had happened right in the thick of things around about July 12. But to give you an indication, at Watercrest, Checkers had already started trading by the weekend. So unrest was on the Sunday and the Monday. Checkers was completely looted, and Checkers was the first of our large retailers to open at Watercrest, and they were trading on Saturday and Sunday already. So very impressive. Just to go into some of the detail, at Watercrest, we've got 92% of our retailers have reopened. Game is not reopening there. They will see out their lease. That lease expires in April of 2025. The GLA of that store is about 4,900 square meters. Just Watercrest, we do own 50% of that. We don't own 100% of that. So our exposure there is 50% of the 4,900 square meters. The damage and loss of rent was estimated at 11.9 million. And like I said, pretty much all of the retailers are open and trading. And if one had to walk the site now, you wouldn't. It's not noticeable that there was any event in July. City View was completely looted, but there was also some fire damage there. It took a bit longer to reopen the entire centre, but as at today's date, 94% of retailers have reopened. Damage and loss there about just under 16 million rand. On both of those centres, we have submitted claims to Sasria, and those claims are being processed. We expect to recover the full amount of those insurance claims. I think part of the problem with the looting and damage to some of these centres is that there will be certain retailers and mostly independents, and so there are a few retailers who are just not going to reopen, and I think that they haven't got the necessary financial means to recapitalise those businesses, and to the extent that they have insurance, they might be taking that insurance payout and moving on. So I think there will be some net fallout. But on the whole, we are, well into our 90s, 90% in terms of reopening. One of the other impacts or themes that the unrest had on not only our portfolio, but I suppose all the landlords' portfolios, is that it put a pause in various retailers' rollouts of upgrades and new stores and that, because obviously the focus for the retailers was on repairing and reopening damaged and looted stores. So there will be a bit of catch up, hopefully, later on in the financial year. Having said that, we are seeing increased numbers of retailers upgrading stores. That's very, very positive. Like I said, there was a delay as the focus has been on getting their unrest damaged stores opened. But clearly there is a trend and a theme of retailers reinvesting in their stores. That's very, very encouraging. We saw our arrears on the arrears side. We saw them peak in 2020. They have been improving. They have improved from June 21 to date. I think the big sticky areas in our portfolio are Ster-Kinekor and CNA, which are the two largest retailers. Both of those retailers are in business rescue. And we expect some answers very shortly from the business rescue practitioners of Ster-Kinekor. But what is happening is essentially what you're doing is you're raising that rental on a monthly basis only to make the necessary provision as well. So that is why those arrears are increasing on the back of Ster-Kinekor and CNA. On CNA, we've reduced our exposure to only 2 stores. Those 2 stores are small stores in one is in Alberton City, one is in River Square. So our exposure to CNA is very, very small. Having said that, the arrears to date are material. We are seeing, we have seen requests for relief, but that has substantially decreased, both in number of requests and value. We are still providing limited relief, mostly to your restaurant sector, and in some instances to personal care. But like I said, that has substantially reduced. E-commerce, there's a lot of talk and a lot of noise about e-commerce. We have seen strong growth in 2020, estimated at 2.8% of total retail sales. We are aware that expectations are that it will grow to about 3.5% to 4% in 2021. We're very clear that omni-channel is the focus, and we're of the belief that e-commerce extends the retail experience. And that is what we were working with our retailers. One of the main drivers for e-commerce has been on demand, and that has been incredibly strong, as evidenced by the growth in Checkers 6060, Woolworths Dash, Uber Eats, and Mr. D. The great thing about that for landlords is that in pretty much all of those instances, the orders are fulfilled from the store, which means that it is supporting our bricks and mortar retailers, and is supporting our shopping centres. We've spoken a bit about valuations, just that they have declined for 3 years, but that rate of decline has slowed. And then really we expect further COVID-19 waves. We expect that they will negatively impact retailer and landlord performance. I think there's no doubt that a 4th wave is coming. I expect that it will be less severe than previous waves, or at least hopefully I'm thinking that it will be less severe. But what both landlords and retailers would really like at this point in time is to have an uninterrupted trajectory of trade, in order for the trends that we're seeing up until now, which is a trend of recovery, to continue and gain momentum, so that we can all get down to the business of running retail and growing. Just on our sales, acquisitions and developments, not a hell of a lot of activity in acquisitions. I think that's understandable. We have, like I said, had two properties transfer since year end. That was Helderberg Hyper in Somerset and Emerald Alberton, both of them in September 2021. Edgar's had transferred in last financial year, and we do have a couple of other centres that we have accepted offers on, and where those transactions are now unconditional. And obviously, we're just going through the necessary process in order for transfer to take place. On the developments and extensions, also very, very slow. And I think that those who listened to the presentation last year will remember the Lakeside Mall conversion of New Metro to Pick n Pay. The reason that it's in this slide is because it only opened in July of 2020. Middestad opened in September of 2020. Lelusha, the Crazy Plastics, that was in November of 2020. All of those developments are trading quite well. All of them are obviously 100% let, and we are monitoring those and the progress of those very actively. What we have seen is the most recent project to be completed was the installation of solar PV plant at Lakeside Mall. That was completed in October of 2021, and that is in line with our strategy of rolling out as much solar PV at our buildings that we can. Obviously, it's dependent on a number of factors. Where we've got existing malls, we are traditionally putting those structures on existing roof structures. You are limited then you're limited with regards to existing space that you can utilize for these plants, as well as what the roof structure can support in terms of weight. So in some instances, we may have lots of roof structure or roof space available, but the roof structure cannot support the weight of those solar plants. In other instances, and this is what happened at Lakeside Mall, where we were able to strengthen the roof structure, that allowed us to free up more roof space for solar panels, and hence we've had a project which is obviously a very lucrative project from a return base, but it's it's very much aligned to our strategy of sustainable development at our shopping centres. All right, if we look at vacancy trends, I think, and this is a slide from MSCI which came out relatively recently. It's really just showing the trend of vacancies across the various centre types. Since December, we've seen a deterioration of overall vacancies. In June 2021, that vacancy rate was sitting at about 6.8%. And if you look at the bottom right of the table, you'll see that each centre category had a deterioration in the vacancies, led by small regional, and neighbourhood faring the best. But it was still a slight decline. So you're seeing a decline from super regional right through to neighbourhood. Is it surprising? Probably no, but I think it's obviously quite concerning to see it as specifically as that in that slide. But that is very definitely an industry trend. If we look at our foot count trends, as I've said previously, that our foot counts have been obviously severely impacted. We haven't seen foot counts recover fully. The trend is similar across all of our centre types. We're not at our pre-COVID levels, as I said. If you look at our graph, which is the graph on the left, you'll see that our community centres recovered better than the rest of the other centre types, being large regional and small regional. And in actual fact, small regional would have recovered or would have shown a better recovery. The one centre in that is really impacting that recovery is Golden Acre in Cape Town, where it is very reliant. It's a commuter centre, very reliant on the trains operating, and as has been well publicised, there are very few trains that are still operating at this particular point in time. So we had numbers at Golden Acre, where Golden Acre was seeing probably about 2.5 million people pass through that shopping centre on a monthly basis. That dropped to below 1.5 million at the peak of its COVID impact. Still hasn't recovered, and obviously dragging those small regional shopping centres down. If you look at the graph on the right, that's the MSCI graph, and that's a graph, particularly the yellow bar charts, that really just shows the number of people per shopping centre per month, and how after COVID that has been substantially impacted and hasn't recovered to pre-COVID levels. And those are typically, or those trends are typically what we're seeing at definitely the Growthpoint portfolio, very much in line with what we're seeing in MSCI in the benchmark. But just to give you an indication, it's, MSCI benchmark is talking about or looking at about 5 people per square meter of GLA per month, which is actually very low. Obviously, as I've said, that recovery is happening, but it is off obviously quite a low base, and we'll watch that. We'll watch that closely. Our trading density by center type. This is the graph on the left. As expected, you'll see that community shopping centers. Sorry, as expected, you'll see the community shopping center, both our portfolio and MSCI, have fared better during COVID on a density basis. Panic. You'll see that in March 21. Definitely with community centers, what's quite evident there, and that's the blue line that we're looking at, there was panic buying. Very clearly evident, specifically in small regional but mostly in our community shopping centers. And then what you saw is that community shopping centers, while it had a slight decline, and it started from about October to trend positive. We're still seeing that our larger format shopping centers are lagging the community shopping centers, and that we're seeing large regional, specifically ours. And the reason for that is that large regional shopping centers and small regional shopping centers, when compared to community shopping centers, have more exposure to sit-down restaurants, have more exposure to entertainment, likes of cinemas, have more exposure to games, arcades, and department stores, which were typically very slow to recover through this period. Your smaller format centers, like your community centers, had a higher pro rata percentage of GLA used and occupied by retailers that were selling essential goods, such as your supermarkets and your pharmaceuticals and that. If you look at the graph on the right, again, this is an MSCI graph. And what you'll see is that only community shopping centers are trading above, on a density basis, are trading above their pre-COVID levels, whereas all other center types have been trading below. And that's quite an interesting graph, and obviously very interesting to benchmark our portfolio against the MSCI benchmarks. Okay, I think that again, both of these graphs are MSCI graphs, and really the point that I wanted to make here is that the post-lockdown recovery was led by food and apparel. You can see that on the graph on the left, where we're seeing food in red and apparel in blue. It's not to say that everybody or every retailer in apparel had recovered. I think that definitely in apparel, we're seeing that your value fashion retailers led the recovery for apparel. And that is, they have a relatively big weighting in the apparel sector. And then on the food side, your supermarkets, they obviously traded well and were less impacted because of the essential nature of their goods. And again, like I said a little earlier, not everybody in the food category, not everybody in the apparel category is equal. There are winners and losers in those categories. There are, performers and laggards within each of those categories, and it's very interesting to drill down into the detail to see who is outperforming and who is underperforming. If we look at the Growthpoint portfolio, and I think, let me just make a comment here. What we've done with these slides is we've indexed, this is turnover, this is reporting on monthly turnover on a year-on-year basis. This is not density. And what we've done is we've indexed this to September 2019. So September 2019 would have been indexed to 0 or 100%, sorry, to 100%. And we've taken September 19 as the base data because it was probably the last clean month that we had to compare to. So if you, for instance, if you take October 19, November 19, you're leading into Black Friday and Christmas. January is still lagging from holidays. February is traditionally a poor month, and then March you already had your lockdowns or restrictions in place. So September 19 is, in our view, the last clean month in order to compare where your turnovers are relative to today's dates. So what are we seeing in apparel? We're still not at September 19 levels in some instances. We've definitely shown a recovery since January of this financial year, January 2021. And what you're seeing is that in July, you'll see that there was an impact from the unrest, which definitely impacted apparel within all of our shopping centres. Interestingly enough, we thought August would be quite bad. It was less impacted in our portfolio. But again, like I said, directly impacted, we only had 2 centres. But August was a sufficiently fair trading month from an apparel point of view. September has been substantially better. I think I've mentioned it a couple of times. You'll see that the apparel and the recovery of apparel has very definitely been led by value fashion retailers. It's very clear when we drill down into the different retailer types that they've clearly outperformed from last year, May, June, but substantially coming to light from January 2021. Probably not surprising there. If we look at the slide on the right, and we're talking health and beauty there, health and beauty is, it's really a smorgasbord in terms of a category, and that includes the likes of Clicks, Dis-Chem, all your beauty salons, your health and beauty shops. But in our sample, what we know is about 85% of that category is made up of Clicks and Dis-Chem. Both of them have performed, sufficiently well. We're seeing that probably from about July, they had already bounced back to their above their September 19 levels, and you'll notice that there was substantial panic buying from March in that category. If we look at food service on the left. Food service, like I said, has been more severely impacted than most. Food service, just to give an indication, is your restaurants and fast food. You'll see that the decline was the most severe out of all of the categories, understandably so. What you'll also notice is that the recovery was the longest, and they're still trading well below their September 19 levels. That's where we're seeing the majority of requests for relief and assistance, and that is where we are providing the majority of the relief and assistance. Also, incidentally, you'll see that there are substantial arrears in that category. And again, the devil's in the detail here. What we'll see is that our fast food has been, much less severely impacted and has pretty much recovered to pre-COVID levels. But our sit-down restaurants are lagging. And then within the sit-down restaurants, you have to divide that even more. Where you've got sit-down restaurants that don't offer indoor-outdoor seating, you are seeing that they are recovering at a slower rate, such as in-mall dining, in-mall coffee shops, definitely slower in their recovery versus restaurants that have a full outdoor dining section. Lastly, if we look at food is your supermarkets, and you'll see that the recovery is pretty much there at September 19 levels. Again, you'll see panic buying in March 2020, then obviously a dip. What we're seeing is that the recovery is slower due to our center format, because we are slanted towards small regional and regional shopping centres. We did see that our community centres recovered quicker from a supermarket point of view. And then what we're seeing is that the smaller format supermarkets within our portfolio perform better than the larger hyper supermarket formats, which is probably in line with what we are seeing in terms of shopper behavior, avoiding large shopping experiences and gravitating to more of a convenience element in terms of the supermarket shop. We saw from October 2020 we were back at pre-COVID turnovers, except for January 21, which was the end of the third wave. Very quickly on arrears and rental discounts. I think the theme that we just want to get through there, and these are two slides that were taken out of our June 21 financial results. Collections have improved, arrears are reducing. Like I said, we've got some sticky big arrears, which is really the largest of our arrears is Ster-Kinekor, fully provided for. CNA is the second largest area, fully provided for. We do expect a result from the business rescue process for both, well, for Ster-Kinekor that's imminent. And then on the right, really what we just want to convey is the request for rental discounts has substantially declined, as has the approval from our side and granting of that. And yeah, I think if I could just end off there, I think what I'd like to say is we've been through a very difficult period. It has been difficult for both the landlords and the retailers. We're very definitely seeing green shoots. We're seeing positive momentum. We're seeing it both in trade. We're seeing it in terms of leasing activity. We're seeing it in terms of trading performance, and we're seeing it in terms of upgrades to stores and that. So, we are continuing with business as usual, and obviously hoping for this momentum to continue well into the future. Thank you.
Thank you so much, Neil. We've got quite a number of questions already in the chat box, so I think it's best to maybe just run through them one by one. Some of them I've received directly via mail and WhatsApp, so I'll go through them in order. How much more assets would you look to sell, and which segments would this relate to?
Okay, so look, I think the answer to that is we have identified certain of our properties as core and non-core. We have an active disposal strategy around our non-core shopping centres. We've been quite successful in disposing of identified shopping centres in the last 6 to 9 months, and what you'll see is through the course of the next couple of months, you'll see a couple of those additional transactions materialize. More than that, I think, unless there are drop dead offers that are so appealing, we will probably slow the taps on our disposal process. So I think you're probably looking at 3 to 4 shopping centres which may transact during the course of additional shopping centres which may transact during the course of FY22. But they are, they're at varying stages of the transaction process. Some are unconditional at the moment. Others are going through a due diligence process.
I've got a question from Yusuf regarding the vacancy performance. Please, can you advise where the increase in vacancies were concentrated? The retail specialist REITs appear to have performed better in terms of maintaining lower vacancies.
Yeah, so in fact, our vacancy to June 2021 was 6.2%. What we have done is we've done some substantial letting post June 2021. And that has been across a number. Well, it's been across a number of our shopping centres, but it's in the likes of the old game space that that some of that space has been, well, all of that space at City View has been relet. We've let all of the space that Dis-Chem vacated at at Waterfall Value Centre, and then there's been some letting in Bayside Mall as well in Cape Town. So yeah, we've done so. It's been very positive actually on the back of all of this increased letting activity from the retailers. Yeah.
Thanks. I got this mail via email. This question: have disposal yields realized for properties sold been at big discounts to yields used to value properties at prior appraisal dates?
No. So what I can say is that what we've experienced is that we are selling our properties at above our valuations, and that has been the trend. And I expect that to, if we're looking at what we are looking at disposing of now, I expect that to be the trend on our disposals that I've mentioned previously.
Myra has a question with regards to the valuation inputs and assumptions. What is your long-term vacancy assumption, and how has this changed versus pre-COVID to now?
Well, very definitely the vacancy assumption is just one of the assumptions, and clearly the metrics and had deteriorated across the board with with retail, and the valuers took that into account. But what we've done is we've worked through it with them, and they have in the valuations as of June 21, they've moved out some of those vacancy assumptions to slightly longer vacancy periods. But it's not wholesale across the entire portfolio, and it's very centre and premises specific. But yeah, I think that sentiment was probably at an all-time low when we did our valuations for June 20. And when we did our valuations for June 2021, they hadn't fully recovered that sentiment. And I think already that sentiment is better now. And you'll see that different vacancy or improved vacancy assumptions will be implemented in our valuations for the next or for the FY22.
And then just a question from Nessie on the categories of tenants that are struggling. Where are rent to sales ratios currently? Across the retail portfolio, rent to sales ratios looking more sustainable for tenants, or are you still concerned?
Yeah, so I think that what has been a very important theme of how we have conducted our business over the last 15 months or 18 months is that we've gone in and restructured a lot of these leases in order to bring these rent to turnover levels more in line, more sustainably, so that retailers can survive and push through this. We haven't just reduced those rental levels to reflect the lowest of the turnover levels, but we've made informed decisions through proper analysis of each of those retailers. So you might find that some of them are still elevated, but the turnovers are improving, and each month you're seeing those rent to turnover ratios improve with the improved trading performance.
And then just another question on vacancies from Umar Farouk. And I guess the question is where is it originating from? Is it more about larger tenants vacating space versus smaller tenants vacating space? And to what extent can this be clawed back? You mentioned the 3 big game spaces.
Yeah, I think, I mean, if you just look at those 3 big game spaces, in total, they would represent probably about 15,000 square meters. And that's a big chunk. But and then we've done some strategic letting where we've moved, for instance, Dischem from the Value Centre in Rustenburg into the main mall, and then it took a bit of time to relet that space, which has been fully let as of November. So yeah, it's specifically we're making great inroads on the smaller premises basis. We are taking advantage of all of that leasing activity where we are right-sizing those tenants. But yes, each game that moves or leaves is a massive setback, and the ability to lease that quickly is you cannot lease that quickly. In many instances, it requires quite a substantial redevelopment of the space. Even if you're just leasing that space as is, there is quite a bit of work to reinstate and white box and get it ready for the new premises. So there will be a couple of months, probably 3 to 4 months for each of those spaces. But yeah, smaller format. Premises, we're seeing lots of activity there. Medium size, lots of activity there, and with the exception of those games and the Woolworths, we're not expecting any major leasing vacancies to materialize. And in the instance of the one Woolworths and the game in Cape Town, there is a redevelopment plan or proposal in place where those vacancies will be let through a project to redevelop that centre.
And then you mentioned the Watercrest game not returning. Yusuf's got a question here. Will Game simply mothball the store? And can you not take the space back to prevent the dead space?
We can. So we are actively looking to see what we can put in that space. From a rental point of view, I think it was just worth mentioning that the rent is secure until expiry. The fact that it's vacant isn't great for the shopping centre, and we will do everything in our power to address that in order to get a retailer trading from that space. If it's not Game, we will look to tenant it with somebody else. We are looking at possible supermarket opportunities there, as well as redevelopment of the space for something other than Game type big box retail. But yeah, we're definitely not going to sit on sit back and just wait for that lease to expire. Clearly, we need a retailer in there and trading for the benefit of the shopping centre.
And just on Paula's question with regards to, has any portion of the Sasria claims been paid as yet?
On those two buildings, not yet, but we're expecting that shortly.
Ridwan from Nedbank. Quantity of relief provided in FY22 so far?
Yeah, I don't think I can answer that, but it's substantially lower than what we had anticipated, and substantially lower than what we had seen in FY21.
Neil, if it's Lauren, I can just add that we will provide those numbers when we update the market for the first quarter on the 25th of November.
Thanks, Lauren. And from Mo Color, would you have sold more assets if you're willing to sell below book value?
Would we have sold more assets if we would? I think if you're willing to sell below book value, probably, but I don't think that applies to us because not everything's for sale in our portfolio, and we are very particular about what we've identified for sale and the process we go through in order to, or the disposal process. So I think it's a bit of a hypothetical question that doesn't necessarily apply. It doesn't apply to us. We've been very, very particular in what we've identified and how we go about that.
And then the final question from Moesho. How much are you expecting to spend in defensive Capex for the retail portfolio in FY22?
So I think, in order to answer that, I think it might be worthwhile looking back prior to this financial year and the previous financial year, and it's worth saying that the Growthpoint Retail portfolio had substantial defensive Capex spent on the portfolio in a number of centres where we upgraded centres prior to the COVID pandemic. Upgraded centres, we did some extensions. Not all of those were at, obviously an upgrade is not at a accretive yield. We did some leasing and extensions that weren't necessarily at accretive yields. Most of those were defensive and strategic in nature to position these centres for the future. And then we'll continue to look at Capex in order to fulfill and to support our strategies. We've got strategies where we would look to introduce additional supermarkets within the tenant mix of certain shopping centres. In some instances, and in many instances, just introducing a supermarket is not necessarily going to deliver the best return. Typically, what you would find is that supermarkets are generally developed or introduced into a tenant mix of a shopping centre at development phase. But yeah, part of our strategy is where we've got one supermarket anchor in regional shopping centres to look for a second supermarket anchor. And obviously there's some certain hurdles that we have to overcome, but those are traditionally going to be defensive in nature, but very, very good for the tenant mix and performance of the shopping centre.
Thank you so much. There is one more question, but I'll send that to you via email and you can respond directly. I'm just cognizant of time and the next session is about to start in 5 minutes. But thank you so much to Neil and those attending. Hope to see most of you in the next session in 5 minutes. Have a quick break. All right.
All right. Thank you.